Hi there, happy new month guys. We are in February, January is over, and the first video this month we are talking about a question that a viewer asked. They asked me to talk about money market funds, and I have expanded it a bit because we'll talk about all types of mutual funds. And so grab a pen and paper, let's get started. Money markets belong to a group of investment products that we call mutual funds. And basically mutual funds is finance jargon for pooling money together and investing that money in specific kinds of financial instruments. And you find typically that we have a number of fund managers who are licensed by the Capital Markets Authority, and these are the only companies or entities that are allowed to create and issue mutual funds. And so I'm going to go through three types of mutual funds, of which the money market is part of. And in each classification, I'll tell you what they are, what they invest in, and what they are ideal for. So if you're looking to get into mutual funds, where you should put your money in. And I want to start with the money markets, which I guess we all talk about. And money markets, this is a short-term savings product. I wouldn't call it an investment product because the rate and the risk profile is very low. And money markets funds typically invest in commercial paper. This is where companies get some short-term loans from the fund managers. They invest in treasury bills. These are government instruments that are between 30 days and 1 year. And then they also invest in fixed deposits. They negotiate with banks and they get attractive interest rates and they put money there for a specific period. Now, typically in the Kenyan market, almost every fund manager offers a money market product. And you find that they offer returns of between 5% all the way to 11%. Now, ideally, money market is ideal for maybe your emergency fund, that's your nest egg, for your non-monthly expenses. So say you pay insurance once a year, you pay school fees 3 times a year, then you want to put that money in a money market account because typically their returns will be higher than a savings account, and then it's not as easily accessible. So you can't just dip in and withdraw. Now, when you're looking to get or to buy a money market product, there are a number of things you need to consider. One, of course, is the financial strength of the company that is issuing the product, because the regulation around money markets is quite loose. So you want to make sure that the company is financially strong and their governance structures around the way they invest. The second thing is to make sure that the money market fund has what we call principal protection. And what that means is that, should anything happen, at least you get your money back. This is not a legal requirement, so not all money market fund managers offer this. So make sure you ask that. And then the third thing is to make sure that they're offering realistic returns. In finance, we say, there's no magic. So if someone is offering 5-10% or even 3% above the market average, then it's possible that they're not being very prudent in the way they invest your funds. So you want to make sure that the return rate isn't super low, but also it's not super, super high. So that's it in terms of money markets. They are low risk. You can access your money anytime. Most funds will tell you to give them a 3-day notice period so that you access your money. They give a low return, typically between 5 and 10, 11%. Look out for the fund that offers deposit protection. That's it on the money market. Next, we look at what we call a dividend fund. So dividend funds, instead of paying interest monthly, like money markets do, they pay interest quarterly and allow you to reinvest so that you make some capital gains. And while money markets are low risk, dividend funds are more medium risk. They typically invest in what we call blue chip or good stocks in the stock market that have a track record of paying a good dividend every year. They also invest in government instruments, so T-bills, treasury bills, and short-term treasury bonds. They invest in commercial paper, like I mentioned, where companies borrow from fund managers at a high interest and pay within a short time. And then also they invest in what we call corporate bonds. Sometimes when a business is looking to borrow money, instead of going for straight debt, they will issue a bond and invite all sorts of entities, including members of the public, to invest in. So those are the 5 areas where dividend funds invest in. Their focus is basically to have a track record of a consistent income coming in. Now, unlike money market funds, their risk profile is a bit on the medium side, and typically they'll pay returns of between 12% all the way to 15%. But because they are a bit risky, they're ideal for medium-term savings. Because in the short term, sometimes the market may be down and you may not get the returns that you want. So with dividend funds, we encourage that you keep reinvesting whatever returns you make and have maybe a 3-year horizon before you need to withdraw your funds. So just to recap on this, they have a bit of risk exposure because they invest in the stock market, although they'll typically pick good stocks that pay a good dividend. And they also invest in commercial paper, which can come with some risk of the company not being able to pay. And typically, this, unlike the money market, they do not offer deposit protection. So use them where you feel in your financial planning that you can afford some risk of some sort. So that's it with dividend funds. Next, I want us to look at what we call a balanced fund. Thanks for staying tuned. We are almost done, so please don't shut the window yet. On to balanced funds. Balanced funds typically invest in the stock market and government bonds. The reason why they are called balanced funds is because they split the investment into 2, depending on the type of the fund, into different ratios. Some funds you'll find do 60% stock market, 40% government bonds. Now, the government bond side is low risk, almost risk-free, but the stock market side tends to be, medium to high risk, sometimes actually high risk. Now, this means that for balanced funds, they are ideal for longer-term investments, over 5-year investments. So if you're saving, let's say, for university fees, for your child, for example, or if you're saving for retirement, then, and maybe you're 10, 15 years away from retirement, the balanced fund is the ideal sort of investment for you. The only thing to consider is they are higher risk than all the other types of mutual funds. Of course, being high risk, over the long term, they also pay a high return, typically over 15%. They do not pay interest. And the way you invest in a balanced fund is that you buy a unit. So they take all these investments, value them, and give you a unit price. So you buy a number of units, and when the value of the investments go up, the price of your unit also goes up. When the value of your investments go down, like now the stock market has been down from the beginning of last year, you find that people who had balanced funds right now could even have gotten to the loss territory. But now the market is starting to recover, so the units will start to go up. Now, if you're interested in balanced funds, you need to put some effort in looking at the stock market trends. You want to buy when the market is low, when the units are cheap, and then you sell when the market is high. Now, if you're feeling, iffy, or if the thought of the stock market makes your, stomach run cold, it helps maybe to talk to an expert who will advise you where we are at. And once you invest, please, if you go into loss making, do not sell. Markets always recover. Just hold on. You can stop adding more money, but hold on and wait for the market to go up and for your units to recover in price. If you ever get to a point where the market is down and your investment in terms of units is going into loss territory, please, please, please do not sell your units. And this is why I said balanced funds are ideal for the long term. What you want to do is, if you have some capital, you want to buy them when they are cheap and try even out the price. And then the market will recover and it will go to the high side and you'll be able to sell. If you're investing in balanced funds, you need to guard yourself against fear, because what happens is when they start to go down, then we get afraid, we sell, and then they go up and we wish we had held on to them. And if you're feeling, a bit iffy about balanced funds, but you'd still want to invest, it doesn't hurt to talk to someone who understands the market, and they can tell you what is the ideal time to buy and maybe the ideal time to exit. Now that brings us to the end of this video. Today we talked about the money market, we talked about dividend funds, and we talked about balanced funds. Just a disclaimer, with all investments, there is nothing that is guaranteed. But what we need to do is do a risk assessment And then we diversify. So you have a bit of money in a mutual fund, you have a bit of money maybe in a plot of land, and so on and so forth. And at the end of the day, the gains add up. So that's it for today. If you have any questions that you'd want me to talk about, please leave the question in the comments section, and please share this video with your family and friends. Remember, here we save together and we grow wealth together as a community. Till next time, be good. Bye.